This is Professor Harry, and welcome back to Metal Market News, where we cut through the noise and bring you sharp, independent analysis on geopolitics, macroeconomics, and the metals market. What you're about to hear is not just a surface-level discussion, it's a deep breakdown of a rapidly evolving global situation that is reshaping power structures, energy flows, and ultimately the future trajectory of gold and silver. The conversation we're analyzing today touches on war dynamics, U.S. strategic doctrine, oil geopolitics, and the hidden forces driving market behavior. As always, I will not just repeat what's being said, I will dissect it, challenge it where necessary, and align it with broader macro realities so you can understand what truly matters as an investor and observer of global markets. Now let's begin. The first thing that stands out in this discussion is the framing of the conflict itself, particularly the narrative around military escalation and its real-world impact versus perceived impact. What is being emphasized is resilience, specifically the idea that despite missile barrages and ongoing tensions, the actual damage on the ground is limited and not strategically decisive. From an analytical standpoint, this is important because markets do not react to noise, they react to systemic risk. If the damage remains contained and does not disrupt infrastructure, supply chains, or governance structures, then the market interprets this as a controlled conflict rather than a destabilizing one. This distinction is critical because it explains why we often see muted or even counterintuitive reactions in safe haven assets like gold and silver during early stages of conflict escalation. However, I would add a layer of caution here. Historically, conflicts that initially appear contained can rapidly evolve into broader regional crises, especially when multiple global powers have indirect or direct stakes. The assumption that minimal damage equals minimal long-term impact is not always valid. Markets are forward-looking, but they are also prone to mispricing risk in the early phases. What we may be witnessing is not stability, but rather a temporary underestimation of escalation probabilities. This is where seasoned analysts must differentiate between short-term optics and long-term structural consequences. Another key theme introduced is the strategic objective of the United States, particularly in preventing nuclear proliferation and limiting missile capabilities. This is framed not just as a regional issue, but as a global security imperative. While that argument has historical precedent, what's more interesting from a macro perspective is how this justification ties into broader geopolitical competition. The discussion subtly transitions from regional conflict to global rivalry, especially in terms of technological dominance and energy control. This is where I believe the analysis becomes more revealing. The mention of an AI Cold War is not rhetoric, it reflects a real and emerging paradigm. The competition between major powers is no longer about strength, but about technological supremacy, data dominance, and resource control. And at the center of all of this is energy. Without energy, there is no AI infrastructure, no data centers, no industrial output. So when we talk about oil-rich regions, we are not just talking about traditional economics, we are talking about the computational power and global leadership. Now, while the argument suggests that controlling or stabilizing oil-producing regions is part of ensuring responsible resource management, I would challenge the framing slightly. Geopolitics is rarely about ideal outcomes. It is about influence, leverage, and strategic positioning. The idea that interventions are purely for stability or modernization overlooks the complexity of competing interests. As analysts, we must always ask, who benefits, who gains leverage, and how does this reshape global alliances? From a market perspective, this matters immensely. Because when energy flows are tied to geopolitical strategy, volatility becomes structural rather than temporary. And when volatility becomes structural, metals like gold and silver eventually respond, not always immediately, but inevitably. Moving deeper into the discussion, the focus shifts toward the rationale behind differentiating Iran from other nuclear-capable or missile-capable nations. The argument presented is that while many countries possess such capabilities, their use is largely deterrent-based, whereas Iran is portrayed as potentially more active in leveraging these tools. This distinction is used to justify the urgency and necessity of current operations. From a purely analytical standpoint, this is a classic case of threat perception shaping policy. Every major geopolitical action in history has been justified through a narrative of exceptional risk. The comparison to historical events, particularly pre-World War II complacency, is intended to reinforce the idea that inaction could lead to catastrophic outcomes. While such analogies can be powerful, they must be approached with caution. Does not repeat in exact patterns, it evolves in context. Drawing direct parallels can sometimes oversimplify complex modern realities. What's more relevant for us as market analysts is not whether the comparison is historically accurate, but how such narratives influence policy decisions and, by extension, market expectations. When governments frame conflicts in existential terms, it often leads to prolonged engagements, increased defense spending, and heightened uncertainty. All of these factors have long-term implications for inflation, currency stability, and commodity demand. Another layer introduced here is the role of public perception, particularly within the United States. The discussion highlights division, skepticism, and differing ideological views about foreign intervention. This is a crucial point because domestic cohesion, or the lack of it, directly impacts policy consistency. Markets prefer clarity and predictability. When a nation is internally divided, its policy becomes less predictable, which in turn increases risk premiums across asset classes. Now, let's connect this to metals. Gold and silver are not just inflation hedges, they are uncertainty hedges. When confidence in policy direction declines, when public consensus weakens, and when geopolitical narratives become polarized, investors begin to seek stability in the traditional financial system. This is where precious metals regain their relevance. However, in the short term, as the discussion correctly points out, we often see the opposite effect. Prices can decline during periods of heightened tension. This seems counterintuitive, but it is actually a function of liquidity dynamics. When investors face margin calls or identify opportunities in other asset classes, they liquidate even their strongest holdings. Gold and silver become sources of liquidity rather than safe havens, temporarily. This is why timing is everything in this market. The initial phase of conflict is often marked by confusion and reallocation. The real move in metals typically comes later, when they begin to fully price in the long-term consequences, whether that be sustained inflation, currency debasement, or systemic instability. As the discussion progresses, we see a more transition into market mechanics, particularly the behavior of gold and silver during times of geopolitical stress. The explanation provided revolves around two primary factors: profit-taking and interest rate expectations. Both are valid, but they only scratch the surface of a much deeper dynamic. Let's start with profit-taking. When metals have already experienced a strong rally, early investors naturally look to lock in gains, especially when new opportunities arise in other sectors. This is a normal market function and does not necessarily indicate in the underlying thesis for metals. In fact, it often resets the market, creating a healthier base for the next leg higher. However, what many overlook is that institutional players operate on a different timeframe than retail investors. They are not reacting to headlines, they are positioning based on macro cycles. So when they sell, it is often strategic rather than emotional. The second factor, interest rates, is where things become more complex. The argument suggests that rising oil prices could force central banks to maintain or even increase interest rates, reducing the attractiveness of non-yielding assets like gold and silver. This is a well-established, but it is not absolute. In reality, what matters is not nominal rates, but real rates. If inflation rises faster than interest rates, real yields remain or even negative, which is highly bullish for metals. This is where I diverge slightly from the presented view. The assumption that central banks can simply raise rates in response to inflation ignores the current debt environment. Global debt levels are at historic highs. Aggressive rate hikes in such an environment can destabilize economies, trigger credit crises, and force policymakers to reverse course. In other words, the ability of central banks to control inflation through rates alone is. If we accept that premise, then the long-term outlook for gold and silver becomes much more bullish. Because if inflation persists and rates cannot rise sufficiently to counter it, real yields will remain suppressed. And in such an environment, metals are not just attractive, they become essential. Another interesting point raised is the idea that markets may be wrong in their current pricing. This is a bold statement, but not an unreasonable one. Markets are efficient over the long term, but in the short term, they are driven by sentiment, narratives, and sometimes herd behavior. When fear and uncertainty dominate, mispricing occurs. The key for any analyst is to identify whether the current market reaction is based on fundamentals or emotion. In my view, what we are seeing is a mixture of both. There is genuine uncertainty in interest rates and energy prices, but there is also an element of overreaction. This creates opportunities for those who can maintain a longer-term perspective. Looking ahead, the conversation introduces hypothetical scenarios: the Strait of Hormuz and the potential for prolonged disruption in oil flows. While the probability of such an extreme scenario is dismissed in the discussion, the mere fact that it is being considered tells us something important: the market is beginning to price in tail risks. From an analytical standpoint, tail risks are where the biggest opportunities and dangers lie. They are low probability, high-impact events that can reshape entire markets. Even if the likelihood is small, the consequences are significant enough that investors must account for them. This is especially true in the energy market, where supply disruptions can lead to rapid price spikes. Now, let's connect this to metals again. If oil prices were to remain elevated for an extended period, the immediate expectation would be higher inflation. This could cause central banks to maintain tighter monetary policies, which in the short term could weigh on gold and silver. However, as I mentioned earlier, the sustainability of such policies is questionable. Prolonged high energy costs act as a tax on the global economy, slowing growth and increasing financial stress. Eventually, this forces a policy shift. When that shift occurs, when central banks move from tightening to easing despite elevated inflation, that is when gold and silver typically experience explosive moves. It is not the itself that drives metals, but the policy response to the economic consequences of that conflict. Another critical aspect discussed is the shifting importance of global trade routes, particularly to reduce reliance on choke points like the Strait of Hormuz. This is a structural change, not a temporary adjustment. If supply chains are being reconfigured to avoid geopolitical risk, this implies a move away from globalization toward regionalization. This shift has profound implications. Globalization was deflationary. It reduced costs and increased efficiency. Regionalization, on the other hand, is inflationary. It introduces redundancy, higher costs, and less efficiency. And what thrives in an inflationary environment? Once again, gold and silver. Finally, the discussion moves into long-term structural changes in the global system, particularly the idea that we are transitioning away from the post-World War II order. This is perhaps the most important point of the entire conversation. Because if this is true, and there is strong evidence to support it, then we are not just dealing with a cyclical market shift, but a generational one. The existing, built on institutions, alliances, and the dominance of a single global currency, is being challenged. As countries seek greater autonomy and diversify away from traditional systems, the role of alternative stores of value becomes increasingly important. Gold has always played this role, but silver, due to its dual nature as both a monetary and industrial metal, has unique potential in this environment. The idea that silver could re-emerge as a form of money is speculative, but not impossible. History shows that monetary systems evolve, especially during periods of instability. If even one major economy were to reintroduce silver in a monetary capacity, the demand shock would be enormous. Prices would not just increase. They would reprice entirely. However, we must remain grounded. Such transitions do not happen overnight. They require structural changes, policy shifts, and broad acceptance. What we can say with confidence is that there is moving toward diversification and decentralization. And in such a world, reliance on a single currency or system becomes increasingly risky. So where does that leave us? In my professional view, we are in the early stages of a long-term bull cycle for precious metals. Short-term volatility will continue, driven by liquidity and market sentiment. But the underlying fundamentals, debt, inflation, geopolitical fragmentation, and currency uncertainty, are all aligned in favor of gold and silver. And that, ultimately, is the key takeaway. Not the headlines, not the daily price moves, but the structural forces that are quietly reshaping the global financial system. This is Professor Harry, and this is how an independent analyst sees the world behind the charts.